You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines. Because what matters isn't only what happened, it's what happens next. Let's begin. Today, the Federal Reserve delivered its latest policy decision, opting to hold interest rates steady. This move was widely anticipated, but the accompanying statement and projections have sent ripples through global markets. The Fed's decision reflects a delicate balancing act, acknowledging recent progress in inflation while remaining cautious about declaring victory too soon. The central bank's latest dot plot suggests fewer rate cuts than previously expected, signaling a more gradual approach to monetary easing. So what does this mean? For markets, it's a reminder that the era of ultra-low interest rates is not returning anytime soon. Equity markets, particularly growth sectors like technology, have reacted with volatility as investors recalibrate expectations. Bond yields have also shifted, with the 10-year Treasury yield climbing in response to the Fed's cautious tone. This recalibration isn't just a US story, it's global. Emerging markets, which have benefited from loose monetary conditions, are now facing tighter financial conditions, and currencies like the yen and euro are feeling the pressure. The ramifications of this decision are far-reaching. First, borrowing costs for businesses and consumers are likely to remain elevated, potentially slowing investment and spending. This could weigh on economic growth, particularly in interest-sensitive sectors like housing and automotive. Second, the Fed's cautious stance may embolden other central banks to adopt a similar approach, delaying rate cuts in Europe and the UK. Finally, if inflation proves stickier than expected, the Fed could find itself in a bind, forced to choose between supporting growth or maintaining price stability. What should we watch next? Keep an eye on upcoming inflation data, particularly the Personal Consumption Expenditures (PCE) price index, which is the Fed's preferred measure. Any unexpected uptick could reinforce the Fed's cautious stance. Additionally, monitor corporate earnings reports, especially from sectors sensitive to interest rates, like real estate and financials. These will provide clues about how businesses are adapting to this new environment. And don't overlook the US dollar. Its strength or weakness will be a key indicator of global risk sentiment. So, what is the smart money doing? Smart money. Neutral. While some investors are reducing exposure to equities in favor of cash and short-duration bonds, others are selectively accumulating high-quality assets that can weather prolonged higher rates. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis, Monday to Friday.